Well, good morning and welcome to the Reserve Bank. The Reserve Bank today reduced the official cash rate to 2.75%. Global economic growth remains moderate, but concerns about softer growth, particularly in China and East Asia, have led to elevated volatility in financial markets and renewed falls in commodity prices. Financial markets remain uncertain as to the timing and impact of an expected tightening in US monetary policy. Domestically, the economy is adjusting to the sharp decline in export prices and the consequent fall in the exchange rate. Activity has also slowed due to the plateauing of construction activity in Canterbury and a weakening in business and consumer confidence. We think the economy is now growing at an annual rate of around 2%. Several factors continue to support growth, including robust tourism, strong net immigration, the large pipeline of construction activity in Auckland and other regions, and importantly, the lower interest rates and the depreciation of the New Zealand dollar. Further exchange rate depreciation is appropriate given the sharpness of the decline in New Zealand's export commodity prices. House prices in Auckland are increasing rapidly and becoming more unsustainable. Residential construction is increasing in Auckland, but it will take some time to correct the imbalances in the housing market. Annual CPI inflation remains below the 1 to 3% target due to the previous strength in the New Zealand dollar and the halving of world oil prices since mid-2014. Headline inflation is expected to be well within the target range by early 2016 as the earlier petrol price decline drops out of the annual inflation calculation and as the exchange rate depreciation passes through into higher tradables prices. A reduction in the OCR is warranted by the softening in the economy and the need to keep future average inflation near the 2% target midpoint. At this stage, some further easing in the OCR seems likely. This will depend on the emerging flow of economic data. Dairy debt roughly is about $35 billion. Now that's a big increase since 2003 when it was about $12 billion. So it's a very substantial step up. What's interesting about the debt, or to some extent worrying about the debt, is its skewness. So in essence, the 10% most indebted farmers owe about a third of the debt, and the most indebted 20% of farmers own half of that debt. And then if you look at the banking system, roughly about 10% of dairy loans, dairy accounts for roughly 10% of bank assets. That's probably the way I should put it. I take quite a lot of encouragement out of the survey that Federated Farmers announced. William Rolleston last week released a survey that basically said the vast majority of farmers, and I think the figures were about 6% of dairy farmers, only 6% were concerned about the discussions they were having with banks over mortgages. So that was quite comforting. We think the economy is growing at around 2% at this point. And our forecasts suggest, and they're always conditional projections, but they suggest that the economy might grow at around 2.5% next year and then 3% the following year. The conditions that probably would be needed to create a recession in New Zealand would be something like China slowing dramatically or perhaps moving into a recession. That would certainly create huge problems in Australia and ourselves. or also if the El Nino impact really took hold and continued, right through into the middle of next year or thereabouts, that could have a significant effect as well. I mean, the good news is that, the Reserve Bank or the OCR in terms of the current level still has the potential, if we need it, to be reduced substantially. And the government has one of the strongest fiscal positions of any advanced economy in the world. So in terms of monetary and fiscal stimulus, if it is needed, then, there's plenty left in the tank.